We run an investment bank called Baird Augustine, and we work with 33 family offices deploying $20 billion annually. And we also host a series of events, these Gagger Club events, and also we'll be hosting the Silicon Valley Economic Forum. You guys can look it up or talk to me about it after. But today we're talking about the hottest asset class that's out there right now, private credit. Better returns than your average venture capitalist with less volatility. I don't want to steal everything that Eric's going to say, so I'll please welcome Eric to the stage. Thank you.
Thank you, guys. It's awesome. You get an applaud up front because then, you can credit that right away. I don't like speaking with a microphone and all that. So, who has the worst hearing and sits in the back? Can you guys hear me? Is this loud enough? I get so many thumbs up. Great. We got some friends here on the web here as well. What do you call it? Like the Google link. I'll let this be up there so you can just rest your eyeballs on that a little bit. My least favorite subject is to talk about myself, and that's probably why you guys already picked up. Who is this guy who speaks funny? Yeah, I grew up in the north of Sweden, and we're a little bit more humble, and we don't normally boost and talk about ourselves, so I don't really want to do that. But what I really do want to talk about is private credit, and it's going to be a three-prong uh, kind of prepared notes that I wanted to really share with you. But this is a small, intimate forum. If you have questions, please just shoot them out. Yes, sir.
Can you pretend you're the Swedish chef from the Muppets for us, please?
Okay, so I was challenged to be the Swedish chef from the Muppet Show. The Muppet Show is actually British, so I don't know. But I like that because why don't we have a little fun with this as well? But my goal is really to entertain, inspire, and educate. And then I want to share what our fund is as part of this as well. But please welcome some questions. And the first thing I wanted to just see, I mean, you guys must have seen media and how it's just like constantly like trying to find blood, trying to find headlines to say private credits like the next meltdown and all of that. Has this escaped anyone in this room? Is this news to anyone that we're seeing a lot of noise with this in the business press? Okay, everybody's nodding. All right, let's just move on. But I don't know how many people actually know what private credit is. It's a lot of different things. And it's estimated that it is about 3.5 trillion. This is a big thing uh, today. And it's projected to grow pretty significantly for various different reasons. We're going to get into that a little bit more. But this is a lot where there is some problem in the direct lending to mid-market companies, and also here where there is some mezzanine lending, also in some of the distressed, more opportunistic, where someone is seeking alpha but taking on underlying asset classes that are not necessarily as solid as they are. And there are different other areas of this as well, where you can have, you can buy like pools of this, etc. Where we are at is in the real estate private credit market. So I'm going to preface that at first. But remember that when you see these headlines with all the different problems, and we're going to debunk this a little bit more, what I first want to say is that this is actually just lending. It's nothing new. As a matter of fact, it's, you know, something that's been going on for maybe 5,000 years. 500 years ago, the first bank came about in Italy. And real banks started kind of functioning a couple of hundred years ago. But we've been lending to each other for 5,000 years. That's what private credit is. But that doesn't like really people think like, what is this truly and really? And they just want to have all these like, oh, it's a new asset class. It's the hot thing. So let's start picking on it because there's problems with it. Doesn't make sense to me. Why is it such an upswing in this? It's because banks cannot serve the demand. There is demand for borrowing money. First of all, especially when we're talking about where banks would be able to play and lend, there are government regulations for banks where they actually need to keep some money in the bank for each dollar they lend. So for every $100 they lend, they might need to keep $15, which means they can't use their full balance sheet. So it's capital inefficient because of regulatory issues. The second part, you guys remember the Silicon Valley Bank debacle here, was it 23? After that, and some other, niche banks, they decided that commercial real estate, let's have a little bit less on that. So banks themselves said, we're going to have a smaller percentage into this asset class. So then all of a sudden, you have less supply coming in there as well, because banks, for that reason, decided to make a draconian structural shift and just say less of it. The third thing here, why this is on such an upswing, is that is there anyone here actually owns a bank, runs a bank, or works for a bank? Okay, nobody. Is there anybody who actually likes your bank? Okay, nobody. I mean, personally, I think banks suck. And I've been burnt. I've seen how they burnt entrepreneurs. They say they're going to give you money to a project, and then at the last minute, they pull it back. They change the terms. They don't show up. And honestly, I don't actually know that. Is there anybody here? May I ask you, how long time does it take to build like a Tesla or something like that?
15 years.
One particular one in production. I mean, we're talking about days and weeks to build a car. Let's
Oh,
not
I thought
say
you meant the company.
no. I mean, build a car. I don't know, a few days. How long time does it take to shuffle papers around to just decide if you're gonna get $1 million for that project or not? 12 weeks? It's a lot of bureaucrats shuffling papers around. People that actually need money, they want to buy something, improve it, and then sell it. It's beautiful, true capitalism, right? But when banks are not a reliable partner and they take 2, 3 months for maybe showing up, you know what? If you have a choice, you go to someone else that actually shows up and can underwrite a loan in a week. You handshake, you look at this, you verify that everything's there, and you can get the loan done. That's also why private credit steps in, because banks are just so slow. And then another thing that the banks are doing, there's a lot of debt coming to maturity in the coming years here. And they were lent by banks at maybe an 80% loan to value. Banks now say, yeah, we can reissue the loan, higher interest rate, but we're only doing 60%. That 20% spread needs to be covered by someone. That's also an area where private credit comes in and scoops that up. Yes, Todd?
We've started to see something here in the United States where a bank will say, we're a private bank. How does that fit in?
If they are a bank, they follow bank regulations. So the first rule up here, where they actually have to withhold some capital in their bank for the lending they do, applies. And I doubt that you can call yourself a private bank if you're not a bank. So I'm not sure how to answer that more than that. But
It's just marketing.
yeah, possibly. But if you're a bank, you're a bank. And of course, there are banks that are better than others at doing various things. This makes sense to you guys? Any questions? Why do investors like this? Because if they didn't, it wouldn't be 3.5 trillion and expected to be 5 within a couple of years. Much higher yields. I get almost nauseous when I walk into a bank, and I still use them, and you have this like big, beautiful blue placard that says high yield savings accounts, and then you need to go and do something with your business, and you maybe sign off on a wire because it was bigger than what you can do online. And then the clerk or whomever officer, everybody's called an officer. There's like, hey, do you want to invest in this 4% high yield savings account? It's like 4% high yields? But inflation is about 4%. Plus, the dollar has lost 20% of its value to Swedish SEK the last 18 months. How is 4% high yields? How is that legal to say that's high yields? It's not. But that's basically what a lot of fixed income or CD and things like that is available. 4%. The other reason why a lot of investors like this, and that's more a comparison to equity, is that this is very predictable. If you lend money, which is really what it is, let's just call a spade a spade. If you lend money, you have not just a handshake. There's a lot of security and liens and you know, safety checks involved. That it's not just a handshake, but it kind of it's just an agreement, right? I give you $1 million, you're gonna give me $1 million back over a certain period of time. So I know it's just like a mortgage being on the other side. I know as the issuer of credit what I am going to get paid. So that's very attractive. And you can use it for income, or you can obviously reinvest that income and then you have a steady growth on the underlying asset instead. And given that we are so heavily weighted in so many other asset classes, whether you want to talk about the public stock market, aka the casino, that is driven by random tweets, random acts of war, random this, random that, I don't feel that that is where I want to have the lion part of my money. For me, that is outside of my control. And holding direct real estate can be a great thing. But if that's the only thing you do, then you're at the mercy of that, and then have some challenges with liquidity. And if you can't operate it yourself, you have to hire operators. Your cap rate on the net goes down quite a bit. So that's a strong reason why we see more and more investors are actually looking into this, because it is a good complement to other assets. And of course, you can't just look at the upside and what it is. You got to look at risk reward when you're comparing this. And of course, if you're the creditor, you're higher in the stack of capital than equity. If in a down scenario, equity gets wiped out first, what's left goes to the creditors. That's pretty attractive. I try to make a very simple way to approach and compare this. So when we do private credit, and we do various different things of this, I always start with asking the question, what are we actually lending to? Am I providing money to a company to just extend the run rate in the hopes that they're going to figure out that their product is something that someone want to buy? That's pretty risky. Am I lending money to someone that is already basically printing money and have a beautiful model, but they want to expand horizontally? Do the customers like the product or the services of the company that I am lending to? Do I think that's sustainable? If the answer to that question is yes, that's probably a pretty good place to put your money, whether it's equity or credit. We've all heard this throwing good money after bad, and if we've been invested in deals, it's like so tempting. It's like, oh, one more, try one more, one more. But when you are at the luxurious place of making a decision for the first time, of course, that's a pretty fundamental question to ask. But I think we sometimes overlook it, and we don't think about that for the now and the 3 years down the road. Is this actually sustainable? Do people want that product? The other part of this is that going back to all these headlines again, like, what are you comparing to? Are you comparing this to investing in real estate directly? Are you comparing this to private equity, where most often something new in the future needs to be true in order for you to get a payback? You invest in something, someone has an idea, someone has a product, someone has a technology, something that if a lot of things are true, people are supposed to buy that, customers in the future, and that company is going to make money. And if that is 3, 5, 7 years out and you see that hockey stick projecting up, typically that's pretty high risk, because a lot of things need to change in the world in order for that to happen. So think about that when you're comparing a private credit, if it's with a private equity, if it's with a real estate, or if it's with a casino, or if it's with this high yielding bonds that gives you 4 or 5%. Ryan, I'm going to put you on the spot, but what would you suggest a venture fund returns on average today?
Probably mid-teens
Yeah.
or lower. And the problem with venture is that if you invest in the wrong funds, you could have negative returns.
And that's, now we're talking about aggregate money, pooled money, investing in a lot of different ventures. The stochastic impact of this, if you're doing it yourself and just do 5 deals or 7 deals and all that, yes, you can be lucky, but chances that you're going to be able to get a wider spread return is probably pretty low. So that's why when you're looking at this private credit, you're going to look at the merits of the risks and returns in comparison to the other asset classes. So that's the framework. And the third one, and this has been picked upon a lot in these headlines, is the liquidity considerations. But ask yourself, do you actually need the cash short term? If that's true, you should probably not buy a house for that money and lock it in real estate. You should probably not lend money to someone because that's someone who's receiving that money. They need that liquidity to go build something. So if you're saying 4 weeks later, oh, you know what, I changed my mind. You just repay the mortgage because I want to go invest it somewhere else. Of course, that doesn't work. So it's important to really just understand the liquidity of anything that you're investing in. And this is nothing new to you, but it is remarkable to me that this big name brand media outlets don't understand this and are not looking at the actual structure of how you're lending. If you're coming in a fund, you're an LP. There are terms for how you're coming into this. If you're investing in a venture fund, you're expecting returns 5 to 7 years later. So this is the simplest framework that we look at when we do it. I'm going to go into this and be a little bit more personable and share a little bit more with you how we approach it and how we look at the whole fund. We're in America and we're a litigious place. I'm going to say this is not financial advice, and I'm not suggesting that every family office and everybody should follow this and do our model, but this is how we look at it. And this is how so I run our family office together with my wife, and we have about 25% of our holdings in real estate, and we have primarily residential real estate, and we have taken a very long lens at those holdings. And it's very hard to predict the future, but any skier here, you notice there wasn't a whole lot of snow in the mountains, and we're not going to have a lot of water this summer. It's going to be a lot of problems. So you can think whatever you want about global warming or not, but climate change is real. We have a beautiful retreat in Southwest Colorado, and there's knocking on the door all the time. People from Texas want to come up and stay in our retreat because it is at 7,000 feet and it's right next to a river. I think it was 110 degrees for 110 days straight in places in Arizona last summer. I mean, I like saunas, but that's just dry heat that is just consumes you and makes you don't want to be playing outside. So we have been strategic with our real estate to try to buy properties that we think are going to be great if the sea level rises and other things work. So basically, great places to live. There are many other ways to go about it. What I'm trying to say is be intentional. The next thing we do, and this is our biggest asset class, is private credit. As vividly as I was maybe expressing that I think banks are pretty fat and subpar in their performance, their business model is beautiful. And if you do this right, you can do this right. We do some direct lending. We have some lending that we have provided operational cash to smaller businesses where they just actually needed that for expansion and growth. And then we're taking a lien on the accounts receivable and or inventory, depending on which company there is. Sometimes we have had a convertible right together with it, but that's the kind of lending we do. So again, private credit is just lending. And the lion part of this is going into our fund, which is an extension of our family office. And that's the Valhalla fund, where I'm going to go into and talk about a little bit more. We also do, I don't actually know if that would be categorized as venture business, but we do direct investments in businesses. And our buy box is, do we like the people? Do we actually want to work with this person? This is personal business, okay? Do I believe in this idea? Do I think it's like a good thing that I want to get behind? There's a lot of industries and stuff that I literally don't want to put my money or my name or brand around. So, for example, we led the seed round to fund a defense company in Sweden to fight off the Russians from the Baltic Sea. We're building autonomous drones to actually help preserve freedom in that part of the world. I'm proud of that. I think that's a wonderful thing to do. I was over there last week. Amazing things what we're doing there. And on the other extreme, we're helping some entrepreneurs that are like football coaches, and they're building an app and building gym chains to train young athletes, serious young athletes. And I feel so good about putting my money, my experience of building tech companies, things to work, to actually get unprivileged kids better at sports to receive scholarships to go to college. Who doesn't want to be involved in those things? The Valhalla Fund, we are helping families live in nice, beautiful homes in Middle America. We're helping entrepreneurs being able to build a business by actually providing housing for that. And we create a fancy return to our investors. That's a triple win. That's what we want to do. That's how we do it with our direct business. That's how we do it. Wes, we are invested with some young entrepreneurs in Boston with an AI startup. We're very into that as well. So that's how we do it. And then we have a little bit of speculative investments, and that could be a mineral, a crypto, a stock, something. And we do that because we believe in a little bit of a broader palette. And for liquidity, the speculative is very good because you can liquidate and sell those pretty quickly. So the reason I'm just sharing this with you is I just want to be very genuine with how we do it. And I just want to not suggest do this, but do what makes sense to you and be intentional. And as you're doing that, understand the kind of the broader options of these different asset classes. And I just highlighted the private credit here because the income, since it is structural, you have a handshake. It's basically be on the other side of a mortgage. You know what you're going to get back. And you can reinvest it or take the cash, depending on what fund or how you do this. There are different ways. You can do kind of the balloon version or getting cash every month. Volatility is low. You know what this is. And liquidity is low. You're promised to provide capital to someone. You can't just take it back. But as you are building your pie chart and your intentions with your money and how you're thinking about it and what makes you feel good and how you want to contribute to your family and your world, whatever that is that's important to you, this is a good palette of just start thinking about top down how you should allocate funds. I did this by intention. I thought it was kind of funny. I was trying to get some help with this. The black dotted line, that's actually our Valhalla Fund. Our Valhalla Fund has not been around for 40 years. We're on a third year of operation, but we are tracking steady over 20%. And we compare that to the stock market. And then let's do a little bit more of a simpler example here. If you would have taken 10 grand 40 years ago, just pick the date manually, it doesn't really matter what you do. If you would have invested that in the same return as we do there, as we produce right now, you would have pretty much $15 million. The stock market, in this case, the S&P 500, which obviously has changed over time, that would have given you 800,000. From 10,000, 800,000. That's pretty good. In the bond market, the high yield savings accounts, whatever, great. You put in 10, 40 years later, you have 90. I did not translate this into how much 90 is today versus 10 later. I didn't want to get overly academic or complicated. I'm just trying to illustrate a point. And real estate appreciation. I'm sure many of you, have had some success of buying a house and then just the house is worth more, which feels great. But in terms of if it wouldn't be leveraged, it's actually not that high return. Some areas more than others, but if you grow something 600%, it feels pretty good. But there's like 15 million to 60,000. This is math. Any questions? Someone must be sitting and wondering something. Yeah, Tom.
You could put Bernie Madoff on there. It's got a sudden fall off right at the end.
There's a comment here on Bernie Madoff. Any other questions, suggestions? Any feedback?
I,
Keep going.
I don't like venture capitalists here in Silicon Valley. Tell me why I should be comfortable doing this and not becoming a venture capitalist.
The common question is, I don't like venture capitalists in Silicon Valley. Tell me why I should do this and not
What
feel
they
like.
do is they push.
I'm just repeating because there are no
Yeah.
people that come.
They push people. Give me some income. Go get this out before it's ready. They push people to do bad engineering.
Okay. I have to ask if there's someone else in the audience that have some commentary on that.
I'm a venture capitalist. We can talk later about it.
Yeah.
It seems like this seems more comfortable, more Swedish.
More comfortable and more Swedish. I like it. It's like the Volvo, right? I don't know. I'm just think I'm proud of for the Volvo. It's not particularly Swedish anymore, but now it's made in China. There's actual Swedish flags in them. But Volvo actually did invent the seatbelts. And they decided to patent it, but then make it free for everybody else to use because it was actually such a great thing. So instead of hoarding that and trying to make money out of it, they made it available for everybody else. So I'm sorry, Todd. I don't know. I don't have expert commentary on what you're saying.
Trying to be helpful by asking a question.
No, you are absolutely. I just don't want to pretend that I'm an expert on everything. I have some expertise in this. We do this, and if there aren't any more in terms of what this really is and how it should be and could be compared with other asset classes, I want to jump into the Valhalla Fund. So this is a credit fund in real life. This is our fund. And what I was kind of alluding through a little bit in the setup, what we do, we are lending residential real estate. We are doing this in Middle America, where you have normal working class families sitting and having breakfast in a house that they think is beautiful, and it might be worth probably laughable if you're living here and think, whoa, can you get a home for $300,000, $500,000? And a 500K home is something that people are very proud of, and they live very nicely in it. There is a growing demand for this in many places in America. We only operate in those markets where there is a growing demand for the underlying product. When you build a business, if you can actually have no competition, that's pretty good. Then you actually dictate the rules. And I'm no fan of no competition or cartels, but when you actually are the operator, of course you want to be where competition is less stiff. You're trying to do things to create hurdles for them. We didn't have to create these because, going back to the banks again, when you're in Wichita, Kansas, and you're a developer and you want to buy a house and fix that, and you want to go borrow a couple of $100,000 to remodel that and sell it with a profit, they are not going to take your meeting. They don't want to lend to you. They don't show up. They just don't do that kind of lending. It's too risky. Oh, no, we can't do it. We need to be creative. Oh, we need to answer you before 2 months has passed. They don't do it. And there are national real estate lenders that do it, but they lend here, New York, Miami, where people buying their second or third homes for $5 million mansion on a golf course because those loan tickets are so much bigger, so it's more attractive for the people involved.
And they're using their previous home as collateral, so there's no risk to the bank, correct?
For in what kind of lending?
Well, if you lend them to buy a second home, you can take their first home when they declare bankruptcy.
Yeah, a bank can take a lien on a different property than the one they're lending towards. Yes, you can borrow money on asset A and buy asset B for cash. That's true. Yes, sir.
So how long have you been lending into real estate, residential?
So this fund is on its third year now. So we just finished the first quarter or the third year. And I'm happy to disclose every monthly return we have done.
Yeah. So you're basically filling the void
That's exactly right. That's exactly right. And that's where it's Middle America, or we are in some places where there's like high demand, smaller tickets, and I'm going to come back to that a little bit in terms of the niche with the risk reward with this as well. But everything we do is asset-based lending. We take a 30% equity position, always a first lien position. And for this fix and flip loans, there's also a personal guarantee. So we do two types of lending. This is important to understand because they're synergistic. On the one hand, we're doing residential rehab lending. That means fix and flip loans or ground up constructions. These are small town developers that are maybe buying houses in poor condition or just dirt. And with leverage, they might be able to do 5-6 projects a year. That means they have a business and they can feed their family and they can do it. Their alternative is to go to a rich uncle, strap themselves for cash, or find some true shark that is going to ride their back. That's why 70% of the borrowers into this fund are repeat customers. Because they like it. This is the best they have. You had a comment or question there, sir?
So you're basically, when your construction deal is lending on the after face value for your
Well,
construction.
We can get a little bit more technical with that. Are you guys familiar with what Dutch lending is? Okay, so basically, you do an appraisal of the project as is, and then in the future, right? And when you're doing a Dutch lending structure, so let's say I'm going to give you $500,000 of loan, you start paying for that $500,000 facility right away, but I only issue you 100 for when you have done the horizontal development, and another 100 when the concrete is done, and another 100 when you have erected the frame, etc.
But I'm paying on the full 500.
If it's a Dutch lending, yes, it's all in favor of me.
Regardless of how much you put out.
Right. So obviously, this is a negotiated thing depending on the power you have. But given that we typically are in a position where we have a lot of power and they don't have a lot of choices, we try to do a lot of Dutch lending. So it's very profitable, and the risk is even further pushed away because we make money out of money we haven't even lent. So that's why we know we are in that 30%.
And then for your short term, they usually pull you out with permanent financing, or you stay in permanently.
So these loans, the fix and flip loans, there are 6 months. Okay. If you need them to be longer, which almost always happens, no, I shouldn't say that, but frequently happens, then you pay an extension fee. If you need to change the terms, you pay a modification fee, etc. Otherwise, we get paid back. There is about 300 loans outstanding here right now. About 250 have already been paid back over time. This is cycling this. So remember, 70% of the borrowers are the same guys coming back, so we know our customers. So that's one part of the business. The other part is when we lend money to landlords. This is a different logic. And the banks don't show up to this again. These loans are called DSCR, if you ever hear that expression, debt service coverage ratio. And what it does is that it looks at your house that you have for rent. We do an appraisal on the rental value, not necessarily what your current tenant pays, but what is the market value of rental income for that property, or 10 properties or 10 doors, whatever you have. And say, okay, this is how much income this is producing. Great. We take, again, 30% equity, that's 1/4, or ceiling of how much we lend you. And then how much does that rental income cover? And 8% fixed 30-year mortgage. So we issue a 30-year mortgage. And they typically are 3 points up front, 8% fixed. And then here's the beauty of this. And we're going to do a very simple math exercise here. When we sell those loans, we package them up and we sell them to a pension fund that repackage these as fixed income products. They give us a couple of points on this because they love highly valued underwritten loans that are so strong with these underlying assets with 30% equity and 8% when a typical mortgage is like 6.
What's the credit risk with us? Is it more of a hard money lending, or is it?
This is all hard money lending.
Yeah, so you're dropping down around the BC range of credit.
No, not necessarily.
No.
BC. Again, they're 30% equity position in that, and since the underlying asset is residential real estate,
Yeah.
it's not crap or junk. That's why they're paying us 2 points.
Do you see what you're doing? The market becoming more competitive, more people getting into it now.
It's like anything that is really good. Of course, competition catches up to you
Yeah.
and do it.
But are you seeing more and more people like yourself getting involved, getting in? Is it
It's
still the
it's remarkable how little it is. We have grown this business so fast, and the reason why we're putting in more money into it is that we are growing geographically. This was in Wichita, Kansas. Then it was, in addition, Denver, Colorado. Now it's like 5 more cities and a few more coming. We just go where we have exactly the same model. Can I say that in 10 years it's going to be this good for us and nobody else is going to show up when we're done it? I don't know. Probably not. But then we don't need to be in that market. We are in those markets where demand is high, competition is low. And right now, it's great. But let's go back to that math thing. So think about this, right? We take 3 points up front, and we get 2 points when we're selling it on the back end. 3 plus 2 is 5. We only hold these loans and service these loans for a short period of time. Right now, the average is 45 days. Our goal is to be at 30 days. There is 12 months a year, and if we only need to keep them for 30 days, which we're getting to, that means that we are getting 5% times 12. That's 60% annualized return. Right now it's 45 days, and funny enough, the math works out, so that means 45% annualized return. So for us, this is a pretty great business, and the landlords are very happy because they get leverage of their properties. And to your point, Todd, that's exactly what they're doing. They're leveraging something that has a lot of just molded dead equity sitting there, and that it can't do anything. The money is just dead. It doesn't do anything. They get cash, and they go invest it somewhere else.
So we have a problem here. I experienced this a long time ago. If you buy a property and you rent it, once you have written off your tax advantage, you need to get rid of that property and buy a different one. This seems like a way to use that equity and not have to constantly roll the property that you own.
That is true. That is true. It's we are landlords. We have a few holdings with that, and we're constantly like this, like, oh, do we want to do these other ones? And we're kind of a little locked in this 1031 tax rules. We have 6 months to find and buy and go for something else. What this does, it provides a lot of flexibility, and it provides capital in that market so the landlords can go and invest in other areas and keep building. But that's basically the lending we do. So when you do that math, you start seeing like, whoa, I understand you can print money. And to your point, like, are we always going to be in a place where we don't have competition and customers love us and we can charge a lot? Probably not, but we're doing that.
So I worked for a company in the Chicago Board of Trade for a week. The CEO told me, you can put us on your resume, don't put the name of the company, and don't tell people what we do. If they find out how much money that we're making, there'll be more competition. He said I made him $23 million in one day. 27 employees. 70% of all NASDAQ trades went through his computers that day, and I lowered the latency by 40% in a week.
Yeah,
He beat the competition. He got more of the NASDAQ trades flowing through his market maker, not the other 3 competitors.
yeah. I don't know what to say. That's remarkable.
I'm good at what I do.
That's, I mean, yeah, never heard of that. That's pretty impressive. This is not super alpha. This is not where someone randomly is just gonna, find a gold bar in the closet or pull off $23 million in a day. This is very repetitive, simple business that is just highly profitable, deal after deal after deal, hundreds of deals with small loans. That's what we do. And-
Quickly.
Yes, sir.
What's going to throw off this model?
Competition.
So
No, besides competition.
that's
Good
a
question.
fantastic question. And we have put in $2.5 million into this fund ourselves of my money. Some of that I actually made out here in Silicon Valley when SAP bought SuccessFactors. And 13 years ago, whatever. So that was a good thing. But when we did that, my number one principle with this was we cannot lose principal. Because there are two risks, right, when you're doing this. One is that the return is going to start getting lower. I can live with that. I can live with teens returns if it's consistent and my money is not at jeopardy. But losing money, no, I do not want to do that. I don't want to take an equity position. I don't want to buy like something needs to be true in order for me to get my money back.
May I answer this question?
Yeah, you try, yeah.
So, in '08, the secondary market money dried up. So who he's selling to in the secondary market, when that money no longer is available, then he's going to have a difficult time with this. That's what happened in '08. I'm not saying it's happening again, but
Yep.
that's usually what happens in models.
So that is one. May I just?
Go ahead.
Okay. Yeah. So we have two kinds of lending. The ones that sit on our balance sheet, that's the construction loan, and then the other loans are that. But remember, we only sit on these for a month. Very often have we actually already sold packages before we issue the loans,
Right.
and we will not lose money. If the worst thing that can happen with those loans is that, oh shit, we are stuck now. We got to service an 8% loan. We're still getting paid. There's still a 30% equity position in that. So the worst case scenario has still not happened, but it's going to compress profits if we can't sell them. But clearly we would stop underwriting them if we no longer can sell them. So the risk is that we would get stuck with some of that in our portfolio, and then we have to collect only 8% as part of the construction loans that produces a lot more at the time. That's going to compress profit. But the main risk I am worried about again is how do you lose capital? And given that the loans are so short and there is a 30% equity position in this, you would actually have to have a collapse in the market of 30% in these markets that we are within that time period so that there is no more equity and there is nothing else to sell. That's when we will be underwater. And if you believe a scenario where residential real estate in middle America, where people actually live their first home, are going to collapse by 30%. Can it happen? Absolutely. My thesis with this, though, is that if that happens, we probably have a civil war before that happens because I think the dollar is in the toilet. I think the stock market is back to the Great Depression issues. So I think all of those things are going to happen before it hits 30% within 6 months in residential real estate.
Real estate has never dropped more than 3.5% per region since they've been keeping data on real estate. So
What was the number?
3.5%.
Right.
Never dropped more.
Yeah. So if you believe that this drops 30% within 6 months,
Yeah.
and then also compared to everything else you hold, and you believe that everything else then is fine, yeah, then I don't think you should invest in this. I really don't, if that's what you truly believe in. But back to what this. Oh, sorry, you had a question.
Yeah. So, my question is, how sensitive and/or correlated is this to the macro credit cycle and interest rates?
Remarkably little. So there are the hard money lending, like we talked about here. It's decoupled. Banks don't show up, right? So it kind of lives its own life. So even if the rates go up a couple of points or down a couple of points, it makes very little difference. When it comes to the mortgage loans that we talked about, they're going to be resold. They are coupled to that. They're typically 2 points higher for the DSCR loans versus a residential mortgage. If it all goes down, yeah, we might be sitting on 7 or 6% loans. If the market is 4%, if that ever happens again for residentials, if you borrow it there. So that's very little. The fund also operates with about 20-25% credit. So we have lines of credit here, and we do that to reduce the cost of capital. Our money as investors is very expensive. That's basically the flip side of the return, right? So we do that on a credit line. So if market rates drop, our cost of capital goes down there as well on 25% of our balance sheet, if you're tracking. And so it goes on both ways. But for us, it's pretty much just the mortgages. So unless we get stuck with them on our balance sheet, it doesn't matter. We sit on them for 30 days, 45 days, and then they're sold. What we make money on is the points up front and the yield spread when we're selling them. So it's very low correlation as a whole to the interest rates in the world. Yes, sir.
For the construction loan, maybe you said it and I missed it. You lend to them, they do their upgrades for 6 months. Do you get paid back when they sell, or do these loans get repackaged?
Great question. So the question was, when a construction loan matures, do we get paid off or does that roll over to a landlord loan? This is the beauty of this. Often does it roll over, and it's fantastic because we know you. If you were the developer and you want to borrow money and take a mortgage, we get all those handsome fees one more time and we get another loan. We already know the property, we already know you. There is very low cost of sales. So, yeah, we'll just issue you that loan again. 70% of our borrowers are repeat customers. That's a business to be proud of in any market you are. And what I was also going to say is that we are offering our investors a 12% pref. That means Valhalla makes zero. We are capitalized to service any investor without making money. Anything above that, we share. That's the only fees. There is no asset under management. There are no sign-on fees. There is no other things. We literally just share on the upside. We do want to be different. We are so bullish. We want to be bold. That's why we have chosen to take this model. Because when we are good, you are getting handsomely rewarded. We are tracking over 20% net. I make money. And this triple win, going back to how we want to allocate our money, comes back to this again. Happier families living in great houses, providing jobs for these developers, landlords unlocking capital and can keep investing. Very often are landlords and developers the same person. And our investors are getting 20%. And you said venture funds are in the teens. But we are paying you monthly. If you invest with us now in April, your money goes to work May 1st. Mid-June, well, we tell you how we did in May. And you either reinvest that and just keep growing your capital, or you log into our portal and say, this is my HCA bank. You do that thing yourself, and money just comes to you by the third week of June. That's how liquid the distributions are. We are just expanding. Our model is working. It's beautiful. So we are doing this and we're putting in more money into this because we're being even more profitable as we're getting bigger. Because we still only need one CEO, one legal counsel, one underwriting team. They might scale a little bit. And you guys all know this when it comes to building ventures and looking at that you can have a higher gross margin, and that's what's happening. And on the net, returns are going up a little bit based on that effect. And why is it such great business and provide these returns? I would say it's three things. It's an excellent operation. The only thing is lending and lending in these categories in markets we understand. We don't lend over websites. We only lend where we actually have a loan officer, they're still called that, shaking hands, going and looking at the dirt. We do appraisal with third parties. We don't want to do that in-house because that could be wrong. So we know that it's like independently done. Everything else is just done in-house.
So do you have offices with the loan officers, or how the clients finding you?
So the headquarters is in Wichita, Kansas. And they're basically monopoly. They, sponsor the local basketball team and all that. So that's when it's grown from. Then there is a person in Denver that is managing Eastern Colorado. That's a she. not a whole lot of she's in this this world, unfortunately. And she doesn't need an office. She is recruited and works for the company without a commission. Also, a different way they're doing. The loan officers are not on a commission plan. They get paid for renewals and when loans are being paid back. So they are very incented to make sure customers are happy and that They only promote deals that
So
are
if I have a
better.
home in Wichita, how do I know that you're gonna live?
If you're in Wichita, you know about this company very well.
So are you advertising, or how am I, or if I'm in Denver, how am I getting to, how do I know you're there for, that you're a potential?
Yeah, so these loan officers that are being hired in these various places in Denver and Tulsa,
Okay,
Oklahoma, they come with a book of business. They are being hired because they know the local developers and constructors. That's the beauty of being in a small town.
so you're the wholesaler. You're wholesaling every month.
Pretty much, yeah. Yeah. Yes, sir.
So, what would the minimum amount of investment be? If so, say I'm interested in like investing in you as an LP or however this works. How much would be the minimum, and how how long would my capital be locked up? Considering you say this is a low liquidity environment.
Yes. So the nitty gritty. So he's asking about the terms for joining. Minimum 100K. So we have a low threshold. You have to be an accredited investor. You're locked up for 2 years. After 2 years, you ask us, "Can I get my money back, please?" You don't say please. You just say, "Give me my money back." Then we're gonna return that over 4 quarters. So you're fully paid back after 3 years, but you have to ask for it. And to date, no investor has yet asked for it. So this is not part of the subscription, but if someone does, and if it's a hardship, especially if it's a retail investor that's just put in a few $100,000, it's probably going to be, honestly, if you just think about it, if you want that, over time, money's going to get cheaper. We're not going to share this much with investors when we don't need it anymore, right? So you're probably pretty happy to return. If you put in $1 million and you say, "Hey, I want out," and we pay this much, it's like, oh, we take someone's cheaper million, you know? But that's the technical answer for the question. Thank you.
So at the beginning of the presentation, you had the slide with the headlines, and now I'm kind of more curious about that.
We gotta go read about this, yeah.
Because yeah, can you shed some more light into like what kind of happened behind the scenes with some of those firms, if you're aware? Like I think Blue Owl was one of them, and I don't know if Blackstone had a credit fund they were gating. Like what were some of the complexities behind when people were looking for redemptions for a lot of investors at the same time? And
Yeah, this feels so weird for me to run a family office in a small business and have to stand with PowerPoint slide, and feels like lecturing an industry. But let's go back to the simplest model. Flipping. Okay, the underlying asset. If you don't have a first lien position, if you have a second lien position, if you're lending to businesses that is not fundamentally strong and produce a profit, yeah, throw good money after bad. You lend money to companies that don't make a lot of money. Mezzanine loans, trying to be greedy, trying to get for a higher alpha, underwriting shit. You didn't understand the liquidity consideration. You didn't understand what you did. If you promise to keep a credit line open for 3 to 5 years, and if you're coming in as an LP, even if you're a big one, if you're a GP, you do that. It's like, yeah, you have. That's why we are being very clear on that. It's like, no, don't invest here if you need the money next year to buy a home. Put them somewhere else. This was not understood by many. And if then you get fueled by all this rushing to exit, private credit meltdown, not really. Out of this $3.5 trillion, there are parts here, there are parts here where you have that problem. Not really here, especially not in residential. Not if you do this right. But I feel that it's like kind of weird and a little arrogant for me to sit and say that's why some of these big companies fail. But I mean, it's just lending money. You're lending to someone that is actually not using your money to make a profit. Yeah, the chance that they're going to pay you back is lower. So let that sink in a little bit. I'm just trying to simplify things and call a spade a spade. But what we do, yeah, we are running and you're getting paid right away. And what I was talking about here, we're also different. As I said, we do not take fees from our investors. We only share in the upside after the 12% pref is paid. But this is different from virtually all other private credit funds that is out there. We're just less greedy. We share with all the different fees with the investors, the modification fees, the extension fees, and all that. And the velocity of capital. We did the example of the 5 points times 12, 6 months term rates, because this is how we manage risk. Going back to that, like what can go wrong? How can you lose your money? That's the number one question. But the same mitigation to reduce risk actually drives profit. If you have short duration loans, your risk goes down because loans are being paid back. You're not sitting on something that you hope one is going to be, running a good business forever. You just need to be able to pay back that in 6 months. This also drives profit. This is pooled capital. From our office, I have notes and I felt like, ooh, that's great. I have a 20% direct note. I'm helping a business. I have accounts receivable and or inventory and we're collecting. But I am still then at the risk of that business customers start liking competitors' products more. Regulatory things, firing warehouse, random things that can hurt it. When you're buying in to a lending operation that have hundreds of small loans, average loan size, actually I don't know what it was for March, it's about the same. It was $286,000 in February. That's not a big loan. It's just many of them we hoard. And every single one has a first lien position with a 30% equity. So to get to the crux of what that is, why invest with us then? So this is like the pitch. Well, we believe in this investors eat first. I love this triple win. Creating housing for families, building businesses in Middle America where these guys can actually run a business, and creating handsome return for others. But Valhalla makes money as soon as we go above 12%. And I am so bullish on this. So we have 2.5 million of our own money side by side with you, but we're also serving and taking on all the legal and regulatory and marketing and whatever all the expenses are to run a fund. So we provide that pref model. So we take that risk and your money goes to work immediately. Nothing needs to change in the world in order for you to get paid next month. We're not dependent on technology or something good happening in the world. It just works. And here's another thing coming back to this when you said, how long am I locked in? I look at it the other way too. We have protections through this Valhalla investment vehicle that your money cannot be returned by the underlying lending operation. So structurally, you're an LP in the feeder fund Valhalla. We provide the capital to the underlying lending operation. They don't have time to take money or deal with investors. They rely on us to provide that capital. They have had others, if you put in 5 million, they'll take it if someone just shows up and said it, but they also get a lesser return than what we provide because we negotiated that. But if you put your money in here, it cannot be replaced with cheaper capital in the future. So for me, there's a little bit of a sense of urgency with this because I forgot who asked it. I think it was you asked, like, what happens when competition comes in and all that? Well, there's competition for capital too. Right now, it's about 150 million AUM. When this is 500 or $1 billion, they're going to have more opportunities to go and seek cheaper capital. And then this opportunity is gone. And the other thing too, in terms of strong protections, actually, that doesn't matter. That's like irrelevant. But handsome negotiations on the revenue split and money cannot be returned. And is that possible to read? We are 506 Reg D compliant and 100K minimum for accredited investors, K1 reporting, and the whole period is 2 years and then quarterly paybacks after that at your request. If you don't request, the money just sits there.
Good question. Can you give an example of one of your projects that went up well above and beyond 12%? The distribution went to your investors.
All projects are more profitable than 20%. 12% is the net ref after it's shared with everybody.
Give me example one. Give me one out.
But it is not just one it's a whole pool of loans. It's like hundreds of loans working together. So
Okay.
I don't have data on
A single
each
project.
individual and see like, oh, did this one produce 37 and this one 35? I don't actually have that data. I see how you're thinking that, and it kind of makes sense.
You're
What
gonna
I
have
can give you data on in terms of the pool that is relevant here, and I'm going to actually show you the return here. Let's see.
You're gonna have winners and losers on some of these deals, or are all your deals just absolute winners, right?
No, they're not. But let me share with this the return for all of 2024. Can you guys read this?
Mhm.
Okay.
Yeah, no big.
Yeah, it's not a presentation. This is actually what you can see in the portal as an investor. This gets updated every month, and then you get your specific. But for 2024, let's just do this so we get to today. And annual, if you took the cash, was 25.6% paid out. When you reinvested that was 28.73. For 2025, it's more stabilized. And this is more what we're setting expectations to expect. Every single month, are you getting the lowest you got in 2025 was 1.49, and the highest was 1.66. So talk about that narrow spread and reliable income. That suggests that 19% if you took cash every month. If that's being reinvested, it's 20 and a half. And now, as the business is a little bit bigger, so again, the fixed cost has not grown as fast as the revenue. We're tracking slightly higher. So now it's like 1.6 per month, and it was 1.5. But this is not a hockey stick thing where it's just like gonna go up and be like 5%. But it's also low likelihood that it's gonna go below the 1%. To date, there has been zero capital losses. That doesn't mean that it can't be in the future. There are currently 4 properties out of almost 300 that are in trouble, that are being worked at. They might get repossessed or just sold to someone else at the bargain, where you create a handshake between one developer to the other, because people are always looking for a deal. But given this model and the strong equity position of this, so I can't answer like what's the highest profitability on one project than the other. I can tell you that if you have those loans, the DSCR loans that are actually being, you issue them on Monday and then sold on Friday, then you have 52 times 5%. That would be a 250% annualized interest rate. But it's not really how the business is tracked. It's just the whole portfolio. Everything is trying to get with faster capital. But that's the return, and this is how it looks. If you would have put in 10 grand or $100,000 from inception, this is not how you put in money and some big IPO and you get super rich, but it creeps up over time. 2 years and a quarter have grown 100,000 to 162. At this clip, you're doubling your money every 3.5 years. And then you double it again. You put in $1 million, 3.5 years later, you have 2. 3.5 years later after that, you have 4. So after 11 years, that 1 is 8. That's predictable growth. I invited a friend and an investor into this to share a few words of how he invested. Alex, are you there? Can you hear us?
I sure can.
Do we get to see you? Look at that.
Even better. There we go.
So Alex and I, let's see, how do I get Alex to be on the full screen? Oh, is it? There we go. Look at that. Okay. And Alex, if you could speak up as much as you can, that would be great, so we can hear you.
How's this? Is this loud enough?
Thumbs up in the back, my friend.
All right, great. So the reason Erica asked me to be on this call is I'm one of his very happy investors. And I invested, about 6 months ago, purely on relationship. Eric and I, 13 years ago, when SAP acquired SuccessFactors, we ended up having offices next to each other and doing a very similar role. And we spent some time together, and I had a lot of respect for Eric. So, he moved on, I moved on, but we kept in light touch over the years. And then when he approached me on this, I didn't really do a huge amount of due diligence. I knew I trusted Eric. I knew if he was dedicating his life to it and he was putting in over $2 million of his own money, it was worth a chunk of my cash. So I went ahead and invested. Over the last 6 months, the returns have been exactly as promised, but I've also gotten to know the operation, people, and frankly, how they make money on an intimate basis. And I almost can't believe one that I invested just on a relationship, but I did. But now I can't believe how happy I am because I really understand the business. And this, there are a couple of, there are a number of companies that do this sort of thing, where essentially they find niche markets where it doesn't make sense for companies operating at large scale to invest. And as a result, they get excess returns. And this is exactly one of them. So not only am I a very happy investor, I am planning to put more money in. I'm moving some money around right now to free it up so I can get some more money into the fund. It's also inspired me to go look at other providers like this, again, who have low risk businesses that exist in a volume where they can make large returns, but they're in markets where they will not attract the behemoths. So that's essentially the story of how I started working with Eric, why I continue to be delighted to work with Eric and Caitlin, and so much so that I have invited several friends to speak with them, and those conversations are also going very, very well. Anything else you want me to say, Eric? Anything that I didn't touch on?
I would be remiss if I didn't say that you're also very Valhalla compliant with that beautiful Viking beard that you've grown down there in Florida.
Eric and I did have, I can't remember what we called it. I think we called it the Viking Mafia. After he was, his firm was acquired. There were a number of Danes who were already Scandinavians already at SAP, and then success factor at the management team was Scandinavian. So there was a wonderful network that arose, and unfortunately, I always say about 4 words in Danish, but it was my first language. So anyway, that was part of the element of trust. If you can't trust a fellow Scandinavian, who can you trust?
Well, thank you so much, Alex, and thanks again for not only reinvesting more of your money that you're enjoying this handsome growth with, but also to invite your trusted networks of other investor colleagues down there in Florida primarily to invest alongside you. That's what we want to do, and we have taken an unorthodox approach to this. That's why we do the no fees. That's why we do the pref the way we do it, and that's why we are so keen on sticking to how we do it. And with that, I just want to thank you so much for chiming in here, Alex. I'm sure people were tired of hearing me talk here, not non-stop here for a while. So thank you so much, Alex.
My pleasure. Well, I think I'll check out now because I'm on the East Coast and it's getting close to my bedtime.
All right.
So I'll see everybody.
Good night. Thank you, sir. Okay, we've taken Q&As as we go along, and I hope that didn't come across as cheesy, but I really wanted to emphasize that this is kind of relationship business, and think about the questions you guys have asked. What can go wrong? Why doesn't everybody else do this? Why isn't there this and that competition and all this? It is, though lending has been going on, as I said, 5,000 years. It is new. And when you go home there and start reading about these, maybe you miss this all, then you can see, yeah, it's not this lending that's in trouble. It's when you do mezzanine lending, meaning you have a second position to your company and do that. And you lend to businesses that are fundamentally not strong. And then someone gets spooked and say, I want my money out. Then you start getting pressure that there is no liquidity coming into these funds. And then they get portrayed by media as being crooks because they can't return the capital. So no, this is not something that is a liquid market. You agree to put your money to lend it to someone. That's a contract. So that's what's behind all that. Any other questions or comments, guys? Ryan, anything from you?
No, that was great. I'd like to give Eric a round of applause.
I sincerely appreciate it a lot, guys. And the round of applause after I spoke was louder than the first one, though we've been sitting in the hot room for, what is it, 45 minutes. So I take that as a good thing. Thank you so much, guys. Really, really appreciate it.